Welcome to today's WSC Group webinar, and the topic of today is really important. It's PAYG Withholding tax variations. For those that don't know me and might be getting onto our webinars for the first time, my name is David Shaw and I'm the CEO and founder of WSC Group. So a little bit more about who WSC Group are. We're certified practicing accountants who are trusted advisors, and we have a special focus in property investment, tax, business advice and self-managed super funds. And we do work with you to achieve your long-term goals, and we provide tax, accounting and financial services to clients throughout Australia, including 3,000 property investors. So we have 5 main offices, and also we look after clients in serviced offices or by technology if you're really remote. We also carry out property investment modelling to show before and after tax and cash flow costs results for your investments, as well as discussing the most appropriate structure to use. So we do have a large amount of property investor clients who are building a property portfolio, and it can be through unit trusts. We also have clients undertaking large-scale property developments with the use of partnerships, joint ventures and companies. As I previously said, I'm a CEO and founder, and I have an interest in over 30 properties myself. What I describe with the property focus that we have is that what started off as a keen interest, being a passionate property investor, has now become a substantial business. So we try to give you really good expertise, and today we're focusing on tax variations. So a few questions, really important questions we're going to discuss today is: why is it important to complete your tax variation? The variation costs which are deductible, how we actually calculate your taxable loss. And we also discuss constructed properties, bonuses and commissions, 3 really important issues that need to be discussed for certain taxpayers. And also an important question about adjusting your tax variation when there are changes, and really important items to note. And also, if you're self-employed out there, and we know there's a number of business clients we have, how does the variation work if you are self-employed? At the end of this webinar, then we're going to have one of our shareholders be on standby to answer questions for you. So firstly, what is a PAYG tax variation? And it's amazing how many times I come meet prospective clients and they don't even know what a PAYG tax variation is. So I'm just going to summarise it. It's actually a pro forma estimate of taxable income that's completed between April and June each year. It can also be completed at other times during the year, for example, when you get a new property or you're buying a property for the first time. But generally, we complete our variations between April and June each year, because what happens is at the end of June, if you haven't completed a new variation, you simply go back to your old tax rate. So a variation like a tax return has to be completed each year. And the way we do this is we estimate your likely deductions, say for the current financial year, and we're in the 16-17 year, just about to go to the 17-18 year, and we lodge these with the tax office, right? And then what happens is the tax office actually produce an advice to send to your payroll office, and the amount of tax withheld by your employer is then reduced. That's as simple as how the variation works, right? So instead of you getting a tax refund at the end of the year, you're actually receiving that through the financial year. So that's the main purpose of the PAYG variation, is to ensure the amounts withheld from your income during the year best meet your tax liability. As I've always said, why lend money to the government during the year interest-free? Better to have that in your own accounts. Look, why is it important to complete your tax variation? Besides the tax benefits, even in a low interest rate environment, it actually pays for most of the costs of your property. And we've got an example coming up on that fairly soon. Also, smoothing of the cash flow, really important. Often when clients come and see us for the first time and we ask, have you done a tax variation? The question is 0. no, we haven't done a variation, and we don't even know what a variation is. So the variation, by having less tax taken out of your plate, certainly smooths your cash flow. It also aids property investors with multiple property purchases, right? Some taxpayers can get away with one property and not doing a variation. We'll always say to do that even with one property. But when you've got more than one property, it's really hard to cash flow these properties, even at low interest rates, unless you have a tax variation in place. Now, we're just talking about generally, and this is just going back to some of the basics of property tax. What is deductible? So when we're actually looking at your income, less your deductible costs in formulating the tax benefits to go into your tax variation. What's deductible? Well, pretty obviously there's agents management fee, council rates, depreciation deductible, of course, and you can see down there at the bottom of the page in terms of specifics, having a new property is better because building depreciation is calculated on the original cost. You can see also finance costs, so application fees, mortgage insurance, any bank financing costs are generally deductible over 5 years. Small amounts under $100 can be immediately written off. You've got insurances as well, and I'm talking about building, landlord, contents insurance, all deductible. Interest, deductible, of course. A little bit of a point there, and it's not a topic of today's conversation, but don't mix tax and non-tax deductible loan amounts. That's another topic we'll be discussing this year as a separate topic. Land tax, as much as we hate that, and if you have more than a few properties in one state, you often have land tax, that is deductible. And strata levies, of course, is deductible in most cases. You have to be a little careful if you have one-off capital costs and sinking funds. You can see that property, once the property has been rented, once the property has been rented, and properties during construction where people travel to them, the actual costs of that travel aren't deductible. So that's why we've specifically put in there travel once the property has been rented, and also water rates. Now, right at the bottom of the page, I've just made one little other comment. Having the right percentage of the ownership maximised deductions. What I mean by that is you would always have more of the income, more of the ownership of the property in the higher income earner's name. So again, that's dependent on people's current and future circumstances. How do we calculate the loss? I've got a $500,000 purchase here at an interest rate a little bit higher than now, but about 5.5%, and we were loaning about $525,000, and we're getting rent of about $520 a week. So you can see there, $24,960 is your rent. Then we talked about from the previous slide the council rates, water rates, insurances, management fees, bank charges as well, and interest. Then you can see your first line item is your cash loss. If you didn't have any depreciation benefits, the cash loss would determine your tax benefits. But because we have generous depreciation concessions where we can write off the special building write-off, which is building depreciation, and your plant depreciation, which in this example you can see just says depreciation, and your borrowing costs over 5 years, your taxable loss is actually, in this example, $19,711. Your cash loss is only $10,000. So we get a lot of non-cash costs which can actually be used to reduce your taxable income. Now, what does this all mean? What are the tax benefits in terms of a loss such as this? Now, remembering, depending on what your marginal tax rate is, your tax benefits will vary. And if your tax rate's at round about 34 cents in the dollar between 37 and 87,000, you get about $7 grand, $6,702 tax benefits, and that would obviously be deducted off your your cash loss, so the $10,000 $10,662 less your tax benefits of $6,702 to give you an after-tax cost of property of $3,960. So the percentage of the cost of that property paid by the variation, so you put a variation in place, get your tax reduced by $6,702, is 63%. Now, if you're between $87,000 and $180,000, tax benefits are $7,589, so it reduces the cost of the property even further, and above $180,000, then you can see your tax benefits are actually $9,166. So really all the costs of the property, or 86% of the cost of the property, paid by your benefits. Now, I know interest rates are lower at the moment at about 4%, and the percentages are even higher there, but I like to do a lot of our examples at above 5%. There's a couple of special notes that often new clients coming to us don't realise, or even existing clients that sometimes need refreshing in their memory, is a tax variation can be completed immediately after a land settlement for a constructed property, and or for not a constructed property. Once the property is settled, you can do a variation straight away, even if it's halfway through the year, and it can be updated every time you add to your property portfolio. Clients also with bonuses normally have these amounts taxed at normal rates, so be careful if you receive bonuses. We normally tick it on the variation, but we found payroll officers don't always get the answer right. Also, with clients with commissions, and also say a significant overtime as well, we should do a review of their variation mid-year. That's really important. And also clients who have pay rise through the year, definitely do a new mid-year review. So we're always doing lots of mid-year reviews on the variation to make sure that what we've put in place in the variation is correct. Now, some other important items adjusting your tax variation. Some other important items to note: you can cancel your variation at any time. You might need to do that if you change jobs, and then we have to do a new variation for the new job. You can redo your tax variation during the year, and we've just briefly already touched on that. Always review your variation in mid-February, because you just, never know. Circumstances have changed. You've forgotten to tell us. Diarise at 1st of February to always have that variation reviewed. Because if you have tax payable at the end of the year, you've actually got to pay that tax before we lodge your return. Otherwise, you won't be able to do the variation the next year. So there's a few tricks to the trade when putting these variations together. Right, now just for self-employed clients, and I said I'd spend a little bit of time going through this, because for a self-employed client, they might be a sole trader, for example. They might be getting a wage, or they're just getting income coming into their account, and they want to know how to actually, get the same benefits in the variation. And what we do is we actually reduce your quarterly instalment paid to the tax office. So we'd work out your income, and in this example you can see on the screen, income of $100,000. We then estimate in the same ways as if you were a salary and wage earner, your investment property losses, and in property 1 we've got $15,000 loss, property 2 we've got a $20,000 loss, and you've got your net taxable income of $65,000. Tax on that, about $12,672. We've just excluded the Medicare levy for this purpose, but your quarterly tax instalment $3,500. So instead of paying say $5,000 to $6,000 in your quarterly tax instalment, excuse me, we just pay $3,500. So that's really how we get the benefit of the tax variation when you're a self-employed client. For many of our self-employed clients, we actually meet with quarterly, so we're always working out the benefits of investment properties on a quarterly basis, just not once a year or when the variation changes. Look, I hope this really this gives you a bit of an overview of what a tax variation is and why you would do a variation. It's really important to get your cash flow right when you have investment properties, and this variation is called a 1515. It's available for you, so why not take advantage of it and not lend money to the government interest-free during the year? Because I remind our clients that if you owe the tax office money, they will charge you somewhere between 14% and 16%. So why would we lend money to them interest-free? Better to have it in your own bank account. So look, I hope that really helps you. Certainly talk to one of our WSC Group staff. If you're not doing a variation, make sure that you put a variation in come April, We're just sending all our checklists out for that now, and it's as simple as filling in the checklist. We prepare the variation, you sign it, and then we'll get that lodged with the tax office. So what I'm going to do is just finish the formal part of the seminar, because I know there'll be a number of clients and non-clients who want to ask some questions.